Are we still in this corrective period and investors should still be cautious short term?
I mean, I think we are approaching, once again, an oversold condition, much like we've seen in early February, but clearly the trade rhetoric is real, the trade policy is real. So I think that is going to be a headwind for equities near term. And there's a lot to unpack there. Longer term, I would absolutely say what we look for is the solid fundamentals and the fact that earnings will have double-digit growth once again year over year in Q2. And we will start that earnings season in April. So I do think that the longer-term pillars of support are there, but we do have to get past this near-term trade rhetoric.
I mean, we've mentioned 5% losses for the S&P 500. I was just looking at the stats on the year now. The Dow Jones down almost 5% in 2018. The S&P off more than 3% year to date as well. To go to your point, at what point do investors go, actually, there's huge opportunity here and we should be dipping our toes back in, irrespective of the headlines around TradeGate?
Yeah, I would say, I mean, we've definitely been looking to dip our toe back in, and I think we should continue to do so. I think what we are seeing this year is that not everything is going to go as Goldilocks as it did in 2017. Clearly, whereas tax reform was the big narrative for 2017, trade policy is going to be that for 2018, and that's going to come with a more volatile path. So it's not that the opportunity is not there for investors, it's just that the path to that ultimate result is a lot bumpier than we've grown accustomed to.
I know it's awfully difficult, but let's separate out trade from the underlying fundamentals. I mean, it's easy to forget we actually had a Fed meeting and decision last week because that just got lost in the round.
It was like a month ago.
But I want to put up a chart actually on the Bloomberg which compares the 6-month Treasury bill yield with dividend yield right now on the S&P 500, and you can see the cash, the equivalent of cash, is actually now up a little above the dividend yield. What is that telling us about the relative attractiveness of investing in fixed income versus stock?
Look, fixed income markets have definitely gained some share, some advantage over the equity markets, and that's what the equity markets have been grappling with. But I will say the dividend yield is only one measure of yield to look at, and one other thing that we've been looking at is the buybacks. So if we look at the net buyback yield, you're going to end up with a number that's meaningfully above what the 6-month Treasury yield might imply there. We're expecting hundreds of billions of dollars in buybacks from corporates this year, so that could be a very big pillar of support. And then another way to look at it, of course, is in terms of earnings yield versus, let's say, the 10-year Treasury yield. And on the earnings yield perspective, you're looking at close to 5% earnings yields, whereas 10-year trading at 2.8%. Certainly the advantage is still towards equities.